Have you ever felt a subtle, almost irresistible pull when making investment decisions? A whisper in the back of your mind suggesting you follow the crowd, that safety lies in numbers. We've all been there. That's the allure of herd mentality, a powerful, often invisible force that can silently erode your financial strategy. Think about it for a moment. The market is surging. Everyone's talking about a particular stock, and suddenly you feel compelled to jump in too, even if it doesn't quite align with your carefully laid plans. Or perhaps you see respected analysts downgrading a sector, and a wave of anxiety washes over you, urging you to sell, regardless of your initial conviction. These are not isolated incidents. They are symptoms of a deeper psychological phenomenon, one that has tripped up even the most seasoned investors. But what if I told you that you could understand this force, that you could learn to identify its subtle manipulations and, more importantly, develop strategies to resist its pull? What if you could transform from a follower into a truly data-driven investor, guided by your own rigorous analysis and unwavering principles? That's the journey we're embarking on today. We're uncovering the hidden mistakes in herd mentality, and we're equipping you with the tools to navigate the market with clarity, confidence, and a healthy dose of skepticism. Because in the world of investing, as Warren Buffett wisely said, be fearful when others are greedy, and greedy when others are fearful. Are you ready to challenge the consensus and find your edge? One of the most insidious traps of herd mentality lies in confusing popular opinion with genuine market consensus. Popular opinion is that swirling vortex of emotionally charged narratives amplified by media hype and social trends, often dangerously disconnected from the cold, hard realities of economic fundamentals. It's the echo chamber where fear and greed bounce off the walls, distorting perception and clouding judgment. Market consensus, on the other hand, should represent a data-backed assessment of probabilities, a sober evaluation of risks and rewards, even if it flies in the face of prevailing sentiment. Think of it as the collective wisdom of informed participants, grounded in analysis rather than emotion. Remember the dot-com bubble. Popular opinion, fueled by irrational exuberance and the promise of overnight riches, drove valuations to astronomical levels. A data-driven analysis, however, would have revealed the unsustainable nature of those valuations, the lack of real earnings, and the inevitable bursting of the bubble. So, how do you avoid this trap? Develop what I call a contrarian indicator checklist. Actively seek out widely held beliefs and then relentlessly search for data that contradicts them. Challenge the narrative, question the assumptions, and demand evidence. Remember, popular opinion is a distorted map, while data-driven analysis is like surveying the actual territory, charting your own course based on verifiable facts, not fleeting emotions. The map is not the territory, as they say. Have you ever noticed how easily you can get trapped in an echo chamber, especially in today's hyper-connected world? Social media algorithms and selective news consumption often create these digital bubbles, reinforcing your existing beliefs and limiting your exposure to diverse perspectives. It's a comforting feeling being surrounded by people who agree with you, but it's also incredibly dangerous for an investor. This echo chamber effect fuels confirmation bias, that insidious tendency to selectively seek out information that confirms your pre-existing opinions while conveniently ignoring anything that contradicts them. You start seeing only what you want to see, further solidifying your convictions, even if they're based on shaky ground. So, how do you break free? I recommend a practice I call the devil's advocate drill. Force yourself to argue against your own investment thesis, seeking out the strongest counter-arguments. Scour the internet for dissenting voices, read analysts with proven track records of independent thinking, and actively challenge your own assumptions. Understand that your brain is wired to seek rewards. Dopamine floods your system when you're proven right, and serotonin provides comfort in agreement. But these neurochemicals can sabotage your portfolio. Recognize the discomfort of challenging your own beliefs as a sign of growth, a signal that you're expanding your understanding and becoming a more resilient, data-driven investor. It's time to step outside the echo chamber and embrace the bracing winds of intellectual honesty. How often do you find yourself blindly trusting the opinions of so-called experts? We're all susceptible to authority bias, that inherent tendency to uncritically accept the pronouncements of those perceived as experts, even when their analysis lacks rigor or their track record is less than stellar. We often assume that because someone holds a prestigious title or has years of experience, they must be right. But the truth is, expertise is not infallible. Think back to the 2008 financial crisis. How many experts failed to identify the systemic risks that were brewing beneath the surface? How many lulled investors into a false sense of security with their confident, yet ultimately misguided, predictions? The lessons of that era are stark. Don't mistake a title for truth. I propose developing what I call an expert humility index. Evaluate experts not just on their credentials, but on their willingness to admit uncertainty and acknowledge past errors. Look for those who demonstrate demonstrate intellectual honesty and a commitment to continuous learning. Always verify expert opinions by independently analyzing the underlying data and assumptions. Question everything. Don't simply accept pronouncements at face value. Remember, expertise is earned through rigorous analysis, not bestowed by credentials alone. Don't let a title blind you to the truth. How many times have you felt that nagging fear of missing out, that irresistible urge to jump on the bandwagon and chase the latest hot trend? FOMO, or the fear of missing out, is a powerful force that drives impulsive investment decisions, leading investors to abandon their carefully laid plans and chase returns without proper due diligence. The neurological basis for FOMO is rooted in the dopamine rush associated with potential gains. This surge of dopamine can override rational risk assessment, clouding your judgment and leading you to make decisions you later regret. So, how do you combat this primal urge? I recommend a data-driven solution I call the Intrinsic Value Anchor. Before investing in any asset, take the time to calculate its intrinsic value based on its underlying fundamentals. What are its earnings? What is its cash flow? What is its growth potential? If the market price significantly exceeds your calculated intrinsic value, resist the urge to buy, no matter how tempting it may be. Create a FOMO filter, a checklist of questions to ask yourself before investing in a trending asset. Have I thoroughly analyzed the financials? What is my margin of safety? What are the potential downsides? By forcing yourself to answer these questions, you can inject a dose of rationality into your decision-making process and avoid succumbing to the siren song of FOMO. Succumbing to FOMO can wound your financial confidence and decision-making autonomy. Don't let it. How often do you simply accept the market price as the definitive indicator of an asset's value? This is a dangerous trap, as herd mentality can inflate prices far beyond any semblance of intrinsic worth. Relying on group consensus for price discovery is like navigating without a compass, blindly following the crowd toward potentially treacherous terrain. The independent valuation imperative is crucial. You must conduct your own fundamental analysis to determine the true value of an asset, regardless of what the market is telling you. This requires discipline, effort, and a willingness to challenge the prevailing narrative. Master basic valuation techniques such as discounted cash flow analysis and relative valuation. Don't rely solely on price charts or analyst ratings. These tools can provide valuable insights, but they should never replace your own independent assessment. Develop a margin of safety mindset inspired by Benjamin Graham and David Dodd's security analysis *. Only invest when the market price is significantly below your estimate of intrinsic value. This provides a cushion against errors in your analysis and protects you from the irrationality of the market. Informed decision-making and critical market analysis stall when facing a lack of transparent, data-backed frameworks for qualitative company analysis. Don't let this stall your journey. Embrace independent valuation and navigate the market with confidence and clarity. So, we've journeyed through the labyrinth of herd mentality, exposing its hidden traps and equipping you with the tools to navigate its deceptive currents. We've uncovered the dangers of confusing popular opinion with market consensus, the echo chamber effect, the authority bias trap, the fear of missing out, and the perils of neglecting independent valuation. Each of these mistakes, if left unchecked, can erode your financial strategy and compromise your long-term goals. Remember, breaking free from the herd requires more than just intellectual understanding. It demands a commitment to independent thinking, a relentless pursuit of data-driven analysis, and a healthy dose of skepticism towards conventional wisdom. It requires you to challenge assumptions, question narratives, and forge your own path, guided by your own rigorous analysis and unwavering principles. Take the actionable insights we've discussed today and implement them in your own investment process. Develop your contrarian indicator checklist, practice the devil's advocate drill, create your FOMO filter, and master the art of independent valuation. As Warren Buffett wisely said, the most important quality for an investor is temperament, not intellect. Cultivate emotional discipline to resist the pull of the herd, to remain calm and rational in the face of market volatility, and to stick to your long-term plan, even when others are panicking. In our future videos, we'll delve even deeper into the fascinating world of behavioral biases and explore advanced data-driven investment strategies. But for now, I leave you with this question. Are you ready to embrace data-driven independence and become the architect of your own financial destiny?